Risk Management Procedures Overview. In the last section, you learned the 4 big picture strategies of risk management: avoidance, reduction, transference, and retention. This section zooms in on how those strategies become everyday procedures inside a real estate brokerage. In real life, most of what you will actually do focuses on reduction and transference. You reduce risk by educating yourself, disclosing properly, documenting carefully, and following office systems. You transfer risk by using insurance and, in some cases, surety bonds. The goal is simple. When something goes wrong in a transaction, and eventually something will, you can show that you followed the law, followed your brokerage policies, disclosed what you knew, and kept clear records. That does not guarantee you will never be challenged, but it dramatically improves your chances of resolving problems quickly and protecting your license and income. Education. Education is the first line of defense in risk management. You cannot follow rules you do not understand, and you cannot use forms correctly if you do not know what they mean. A well-trained agent is much less likely to commit a serious error, violate a statute, or accidentally practice law. In most states, the designated or employing broker is legally responsible for supervising and training affiliated licensees. That includes giving agents access to current forms, explaining how they should be used, and setting up internal procedures for reviewing contracts, addenda, and disclosures. A good broker does not just hand out a stack of forms and say, "Good luck." They provide workshops, office meetings, sample files, and one-on-one coaching so that new and experienced agents know exactly how the brokerage expects documents to be prepared and handled. At the same time, education is not just the broker's job. Individual licensees have their own duty to stay informed. That includes completing required continuing education, but it should go beyond the minimum. Markets change, new loan products appear, fair housing law evolves, and digital signatures and online platforms are constantly updated. Agents who rely only on what they learned in pre-licensing courses slowly drift out of compliance. For example, consider an agent who is unfamiliar with the latest version of the standard purchase contract. A line that used to be optional might now contain a mandatory disclosure or a critical deadline. If the agent fills in the form the old way, they might unintentionally waive a contingency, shorten a response period, or miss a statutory disclosure. That mistake could cost a client thousands of dollars and trigger a complaint. Effective risk management procedures, therefore, always start with education, new agent orientation, periodic legal updates, contract review sessions, and broker involvement when unusual issues appear in a transaction. Education reduces risk because trained agents make fewer mistakes and recognize when they need help from the broker or an attorney. Disclosure is another major risk control tool. When clients and customers receive the information they are legally and ethically entitled to, they are much less likely to feel misled or ambushed later. Most lawsuits and grievances grow out of one feeling: if I had known that, I never would have agreed. Good disclosure procedures prevent that feeling. Some disclosures are required by law. Others are required by your brokerage policies. Common categories include agency relationships, property condition, duties and obligations, licensees' personal interest in the transaction, and any financial interest in referrals. Agency relationship disclosures explain who you represent and what duties you owe to each party. For example, if you are a buyer's agent, you need to make sure your client understands your loyalty to them and any limits on dual representation. If your brokerage allows limited dual agency or designated agency, the forms and explanations must be very clear. Failing to explain agency can lead to accusations that you favored the other side or hid conflicts of interest. Property condition disclosures are another high-risk area. Sellers may be required to complete state-specific disclosure forms about known defects. Licensees must also disclose material facts they know or reasonably should know. even if the seller prefers to keep quiet. A buyer who discovers a significant problem after closing will often claim that someone had to know and that the defect was intentionally hidden. Thorough disclosure procedures, written forms, consistent practice, and documentation of what was shared reduce this risk. Disclosures about duties and obligations help set expectations. For example, you might explain in writing that you are not a home inspector, contractor, or attorney, and that your role is to help coordinate but not replace the advice of those professionals. Personal interest disclosures require you to tell all parties. If you, a close family member, or a business you control has an ownership or financial interest in the property. The same is true if you receive referral fees or other benefits from vendors such as title companies, inspectors, or lenders. Transparent disclosure allows clients to decide whether they are comfortable proceeding. Hidden interests are a frequent source of claims and disciplinary action. Disclosure procedures often include written forms, verbal explanations, and written acknowledgments from the receiving party. Good risk management means you do not rely on a quick conversation alone. You back it up with something that can be produced later. Documentation and record keeping. Documentation is the proof that you did what you were supposed to do. It shows what was said, what was agreed to, what was paid, what was delivered, and when. When a dispute arises months or years later, people's memories will differ. The written record, if it is thorough and organized, becomes your best protection. Real estate law and commission rules require brokers to maintain extensive records. A typical employing broker must keep records of every real estate transaction handled by or through the brokerage, as well as employment records for all current and former licensees. These records usually include listing agreements, buyer representation agreements, offers, counteroffers, purchase contracts, leases, escrow instructions, earnest money receipts, closing or settlement statements, agency disclosure forms, property condition disclosures, and other related documents. There are also specific rules for how long records must be kept. Many jurisdictions require at least 5 years from the date a transaction closes or terminates. Records may be stored at the principal office, a licensed branch office, or at an approved off-site storage location, as long as the regulator is notified and the records are readily accessible for inspection. A broker must be able to locate a particular file quickly if the commission asks to review it. Trust accounts and earnest money. Risk management procedures around trust money are critical. Brokers must safeguard client funds, such as earnest money, security deposits, association dues, or rents held in trust. Only properly authorized persons under the broker's license should be permitted to withdraw funds from a trust account. Mishandling trust funds is one of the fastest ways to lose a license and face civil or criminal penalties. Procedures typically require all licensees to promptly deliver any cash, checks, or other items of value received in connection with a transaction to the designated broker or authorized escrow company. Purchase contracts or receipts must clearly state the form of earnest money, whether it is cash, a personal check, a cashier's check, a promissory note, or other item of value. Files must show confirmation that earnest money was deposited and handled according to the party's instructions. Broker review and file organization. Most states require the designated broker to review and initial key documents, such as listing agreements, purchase contracts, and non-residential lease agreements, within a specified period, often 10 business days from execution. The broker's initials and date of review typically appear on the same page as the parties' signatures. Some brokers may delegate this review to an associate broker in writing, but the designated broker still remains responsible. Transaction folders must be maintained in a systematic manner, often with a chronological log or electronic index. A complete sales file will usually contain the contract, escrow receipts, settlement statements, escrow instructions, employment agreements, addenda, amendments, and any release of escrow funds. Rejected offers should also be retained for at least the minimum time required by law, since those documents may become important in later disputes. Policy Manual. A written policy manual is a risk management tool for the entire firm. It sets out the brokerage's expectations before problems arise and ensures that everyone is playing by the same rules. A good policy manual addresses issues such as floor duty, handling of relocation referrals, assignment of leads, internal referral procedures, advertising standards, social media rules, open house practices, and attendance at company meetings and tours. It also explains the brokerage's stance on dual agency, disclosure requirements, and use of specific forms. When agents know the rules in advance, there is less room for favoritism, confusion, or resentment. This reduces the risk of internal disputes and helps the broker demonstrate to the commission that the firm has a culture of compliance and supervision. Procedures Manual. While the policy manual explains what the company expects, the procedures manual explains how to do it. It breaks down the steps for handling every part of the business: taking a listing, writing an offer, opening escrow, handling earnest money, processing inspection requests, dealing with MLS matters, placing signs, and closing a file. A strong procedures manual also incorporates legal requirements. It should explain how to comply with license law, banking rules, fair housing laws, and advertising regulations. When procedures are written, trained on, and uniformly enforced, individual agents are less likely to improvise in ways that accidentally violate the law. When procedures are updated, each agent should acknowledge the changes, often by signing a revised manual or acknowledged receipt form. Standard forms. Standard forms are another important risk management tool. They save time, reduce the chance of drafting errors, and help prevent the unauthorized practice of law. Most standard forms are written or approved by attorneys familiar with local practice and state law. They anticipate common contingencies and provide legally tested language for issues that arise frequently in the market. Examples of standard forms a brokerage might provide include buyer and seller representation agreements, both exclusive and non-exclusive, purchase and sale agreements, listing agreements, agency disclosure forms, property condition disclosure, disclaimer, and exemption forms, residential and commercial lease agreements, personal interest disclosure forms, referral and compensation disclosure forms, lead-based paint, and other specialized environmental disclosure forms, referral agreements between brokerages, independent contractor agreements for agents, closing checklists and transaction checklists. Agents typically fill in blanks, select options, and attach approved addenda rather than writing their own clauses from scratch. However, they must understand the limits of what they may do. If a client requests custom legal language outside the forms, a prudent agent will recommend that the parties consult an attorney. That recommendation is itself a form of risk reduction. Communication records. Good communication is not enough. You must be able to prove it. Risk management procedures therefore emphasize keeping records of important communications. Some communications, such as agency disclosures and certain notices, must be in writing. But even when the law does not require written communication, it is still wise to create a written record. For example, after a phone conversation in which a buyer decides to waive a repair request, you might send an email summarizing the discussion, what the inspection revealed, what options were discussed, what you recommended, and what the buyer chose. Electronic communication, emails, text messages, and messages through transaction platforms should be captured and preserved in the transaction file or in a secure electronic archive. Mailed or faxed items should also be copied and kept. A transaction checklist can help ensure that all required communications, whether incoming or outgoing, are completed and stored. Because phone calls and face-to-face conversations are hard to prove later, many agents develop the habit of taking quick notes during or immediately after the conversation, then following up in writing to the other party. These records often become decisive in resolving disputes about what was promised, what was delivered, and who decided what. Transaction records and accounting state laws require firms to maintain complete written records of all real estate transactions for a number of years after closing or termination. Typical required items include listing agreements, buyer agency agreements, offers, counteroffers, accepted contracts, amendments, disclosure forms, inspection notices, correspondence, and closing statements. Accounting records are a special part of this file system. For each transaction, property, or principal, escrow records should show the depositor, date of deposit, date of withdrawal, payee, and sufficient detail to trace the movement of funds. Clear accounting records allow a broker to show that escrow money was held separately, dispersed correctly, and reconciled regularly. Poor accounting records are a red flag for regulators and greatly increase the risk of discipline. Other important documents. Beyond the core transaction documents, many other records can help manage risk. These may include copies of advertising and marketing materials, training outlines, sign-in sheets from sales meetings, and legal update sessions, attendance records for continuing education, safety manuals, and office policies about harassment and discrimination. If a complaint arises about misleading advertising or inadequate training, these materials help the broker demonstrate that the firm actively works to comply with the law and protect the public. Insurance as a risk management procedure. General liability insurance. General liability insurance is designed to cover risks when someone from the public or a licensee enters a property and suffers injury or damage. For property owners and managers, it protects against claims, such as someone slipping on an icy walkway or being struck by a falling object on the premises. For a brokerage office, it can cover situations like a client tripping over a loose rug in the lobby. If a covered claim is made, the insurer typically pays legal defense costs, court judgments, settlements, and certain medical expenses, up to the policy limits, subject to any deductible. However, general liability insurance does not cover professional mistakes, discrimination claims, or mishandling of client funds. For those risks, other coverages are needed. Errors and omissions insurance. Professional liability in real estate usually falls into two broad categories. First, there is unprofessional conduct, failing to provide the standard of care expected of a reasonable licensee. This might include failing to disclose material facts, missing deadlines, or mishandling forms. Second, there is breach of contract, failing to perform services promised in an agency or listing agreement. Errors and omissions insurance, E&O, is the primary tool for transferring these professional risks. A standard E&O policy provides coverage for damages resulting from negligent acts, errors, or omissions in the course of providing professional real estate services. For example, if you forget to deliver a critical notice by the contractual deadline and your client loses a right to cancel, an E&O policy may cover your defense costs and any resulting damages, as long as the act was negligent rather than intentional. E&O policies do not cover everything. They typically exclude violations of law, fraudulent or criminal acts, mishandling of escrow or trust funds, antitrust violations, sexual harassment, fair housing violations, environmental issues, and acts outside your license or scope, such as performing appraisals without appropriate credentials. E&O is designed to cover mistakes, not deliberate misconduct. Fire and hazard insurance properties are also at risk of physical damage from events such as fire, wind, hail, smoke, civil disturbance, and vandalism. Fire and hazard insurance covers these types of property damage as defined in the policy. Owners, investors, and sometimes tenants purchase these policies to protect the value of buildings and improvements. In property management, making sure that appropriate fire and hazard coverage is in place is part of risk management. A property manager who fails to advise an owner about necessary coverage may be blamed if an uninsured loss occurs. Flood insurance standard hazard policies generally do not cover flood damage. Flood insurance is a separate, specialized form of coverage. It applies to property damage from floods, heavy rains, snowmelt, drainage failures, and failures of public infrastructure such as dams or levees, depending on the policy terms. In certain high-risk flood zones, lenders may require buyers to obtain flood insurance as a condition of the loan. Real estate professionals should understand when flood insurance might be needed and encourage buyers to investigate coverage early. Failure to discuss flood risk may lead to claims if the property later suffers flood damage and the buyer assumed it was covered. Other common coverages. In income and commercial properties, additional insurance types are often part of a comprehensive risk management plan. Casualty insurance focuses on specific risks such as theft, burglary, vandalism, machinery breakdown, illness, or accidents. Workers' compensation insurance provides medical and wage replacement benefits to employees injured in the course of their employment, as required by state law. Contents and personal property insurance covers items inside a building that are not part of the real estate itself, especially when those items are off premises. For example, a staging company's furniture in a listed home might be covered separately. Consequential loss, use, and occupancy coverage is designed to protect against business income loss when a property cannot be used due to a covered disaster. For instance, if a fire makes an apartment building uninhabitable, this coverage may compensate the owner for lost rent while repairs are made. Surety bonds. Surety bonds are different from traditional insurance. They do not simply pay a claim and absorb the loss. Instead, they guarantee that a specific task or obligation will be performed. A surety bond involves three parties. The principal is the person or business that buys the bond and promises to perform the task. The obligé is the party that requires the bond, often a government agency or project owner, who wants assurance that the principal will fulfill contractual or legal duties. The surety is the company that issues the bond and provides a line of credit to guarantee performance. If the principal fails to perform, the obligé can make a claim on the bond. If the claim is valid, the surety pays the obligé up to the bond amount, but then the principal must repay the surety. In that sense, the bond is more like a credit arrangement than a traditional insurance policy. In real estate and construction contexts, surety bonds might be required for subdivision improvements, property managers handling association funds, or contractors performing work related to a development. They help protect consumers and public entities from financial losses caused by non-performance or misconduct, and they are another piece of the broader risk management picture. Review summary risk management procedures turn theory into daily practice. Education ensures that brokers and licensees know the law, understand the forms, and stay current with changes. Disclosure procedures make sure that clients and customers receive the information they are entitled to, and that potential conflicts of interest are clearly revealed. Documentation and record keeping create a verifiable history of each transaction. Proper trust account handling. Broker review, policy and procedures manuals, standard forms, and organized communication records all work together to reduce mistakes and provide evidence of compliance. Insurance and surety bonds provide financial backstops when problems occur. General liability policies protect against bodily injury and property damage claims. Errors and omissions. Policies address professional mistakes and omissions. Fire, hazard, flood, and other property-related policies protect physical assets and income streams. Surety bonds guarantee performance of specific obligations, with the principal ultimately responsible for any loss. When these procedures are consistently followed, risk is not eliminated, but it becomes manageable. Agents and brokers can focus more on serving clients and growing their businesses, knowing that they have systems in place to protect themselves when something goes wrong. Discussion. Why is a written policy and procedures manual such an important part of risk management for a brokerage? Suggested answer. A written policy and procedures manual tells everyone in the firm exactly how to handle key situations: earnest money, disclosures, advertising, offers, and closings before problems happen. When procedures are clear, agents are less likely to guess or improvise in ways that violate the law or company rules. If a complaint or audit occurs, the broker can show that the firm had structured systems in place, trained agents on those systems, and reasonably supervised their work. This can reduce liability and disciplinary exposure. How do communication records help resolve disputes in a transaction? Suggested answer. Communication records, emails, letters, notes, and text summaries provide a dated, written history of what was discussed, recommended, and decided. When a client later claims that they were never told about a defect, a risk, or a deadline, the agent can produce documentation showing that the issue was explained and that the client made the decision. Clear communication records often diffuse disputes early and may be decisive evidence if a lawsuit or grievance proceeds. Closing remarks. Risk management is not a one-time task. It is a daily habit. Every time you choose to document advice, follow a checklist, use a standard form, or ask your broker for help with an unusual situation, you're managing risk. Every time your brokerage updates its manuals, trains on new forms, or reviews files, it is investing in your protection and the protection of your clients. By combining education, clear disclosure, thorough documentation, and appropriate insurance, you create a professional environment where problems are less frequent, easier to resolve, and less likely to threaten your license or your business. These procedures are not just administrative chores. They are the backbone of a safe and sustainable real estate career.